Students, we have an incredible opportunity to speak with Ben Birken about Holistiplan. You've had the opportunity to utilize Holistiplan, and now wanted to provide a little bit of additional feedback on how to view the software, how to maybe step up your game a little bit as you're out there working with clients, as you move beyond Capstone and take the application of what we've learned into client relationships. The fact that you are even touching a tax return is going to put you in one of the upper echelons of being a financial planner. It's just, I think it's a scary area for a lot of planners, but there's an immense planning opportunity to begin to talk to clients. It doesn't always work out perfectly where you uncover a $50,000 nugget for a client, but the fact that you have an eye for detail and foresight for the future can begin with a 1040. So Ben, welcome, or I guess I'm being welcomed to your computer actually. So thanks for the opportunity to talk for a little bit today.
Absolutely. Yeah, everybody's welcome to this computer except for foreign agents and hackers who are most definitely not welcome. So, you were touching on the fact about, the opportunities that are available when you're doing tax planning, and it's true, right? Taxes are like the ivy of anybody's financial picture. They crawl into everywhere, right? They crawl into financial planning, they crawl into retirement planning, they crawl into investment planning. And if you are doing good, thorough tax planning and tax return reviews for clients, you're going to have an opportunity to look like a hero, right? Maybe not every year, might go a few years without it, but every once in a while, you're going to uncover a planning opportunity or even a mistake on a client's return that will either save them money or prevent them from having to pay a whole bunch more money because they submitted something fraudulently. So let's just jump right into it. Obviously, every student has had a chance to look at and use Holistiplan, so good for everybody for getting in here, creating households, uploading returns. That's fantastic. We're actually going to start on this particular student's entry, and I did it on purpose, not to call anybody out, but just to say, in the future, as you're using Holistiplan, either with future work at A&M or potentially with an employer, it's always going to be important to add the birth dates when you can. So, for Cody and Catherine, it's not that big of a deal because of their age. There's not too many age-related things that are happening when you're in your late 30s or early 40s from a tax point of view. But if these were older folks, you start thinking about, okay, well, if we had their birthdays, Holistiplan is actually going to prompt you, the planner, to say, hey, you might want to start thinking about Social Security because they're eligible to start taking it next year. Or, hey, clients over 70 and a half, they're actually eligible to do qualified charitable distributions. That might be something that you talk to them about. Or retirement distributions are going to start since they are turning age 72 this year. So you're not going to see any of that with these particular clients, but it's just be mindful of that. You can also add dependents. So it says clients, but it could be dependents, which in this case, we've got 4 total kids. We know there's a child tax credit thing going on. Maybe there's other dependent care things going on or college related things. So just enter as much information as you can. That makes the system work a little bit better for you, right? But staying here, the first thing that I would look at as a planner, I've uploaded the return. I'm going to look at the tax report itself. It's going to do all the hard work that would normally take a human being time and energy to do. And it's going to shout out, here's the total income. Okay, there were some deductions that brought the adjusted gross income down. There were additional deductions. It's an odd looking number, so that already clues to me, okay, that's the itemized deduction. They're not taking the standard deduction for anything. We get to their taxable income. Tells me what the total tax is pulled from the return, right? So that's just all pulling stuff directly from the return along with the filing status. But now we start getting into some additional points of view, right? What's the marginal rate on the next dollar of income? A little question mark always gives you the little clue as to saying what it is. And you all know marginal rate is what's the tax rate of the next dollar of income. However, we know as planners that not all income is created equal. And so your marginal rate for ordinary income for stuff like salary is different than your marginal rate for long-term capital gains. And we know that's true in this particular case, which we'll get to in a minute. We also have your average rate. There are a couple of different ways of doing average rates. Some accountants do it one way, some folks do it another way. Holistiplan does it by just simply taking your total tax dollars and dividing it by your total income. And again, the little question mark shows you that. So it's total income before any above the line deductions. And we take the taxes and divide it by that, because that's really how much of your total in the door income went towards taxes. Safe harbor, that's more for making sure you pay enough in this year to avoid any taxes or penalties. Based on your income, that's either going to be and they tell you right here, in this particular case, because they make as much money as they do, they have to pay in 110% of last year's tax bill to avoid any underpayment penalties. Column over here talks about, okay, tax exempt interest, didn't see any. That may or may not be important depending on their marginal rate. You know, a higher dollar person here, maybe they benefit from municipal bonds if they own any bonds, maybe they don't. Not so much here going on in terms of qualified and ordinary dividends. There's a little bit there. Here's obviously one big one, right? $55,000 long-term capital loss, which gets carried forward to the 2021 year of $52,000 because they used $3,000 of that for loss for this year. And then any credits claimed, $8,000. Now we know from looking at the return, this was the child tax credit for kids, $2,000 and so on. So far, so good. If I'm telling the story to a particular client, I might go through these somewhat quickly, but spend a little bit more time, particularly as it relates to marginal rate stuff, by jumping down here and saying, okay, marginal rates, we know as planners that there are two different ones. Here's your marginal rate for your ordinary income, which in this case is mostly salary and business income. Plots out in the 24% bracket, in between $171,000 and $326,000. There they are right there. So they've got another $16,000 to go before they jump to that next bracket where stuff gets escalated a little bit. But we've also got those long-term capital gains and qualified dividends, which are eligible for better tax rates. And we know that the next dollar of qualified income will actually get taxed at a rate of 15%. Now, in this particular case, that's misleading, right? The next dollar of qualified dividend income will get taxed at a rate of 15%. But the next dollar of capital gains income will actually get taxed at 0. Why is that? Well, we've got this big carry forward loss. So if we take a capital gains hit by selling appreciated stock like the Tesla stock that these folks own, they're actually not going to pay any taxes on that at all, right? Because it's just going to work off of that $52,000 carry forward loss. So already we've got 3 different levels of taxes to worry about where that next dollar of income is coming from based on its source. The modified adjusted gross income tiers, different planners are going to use this section in different ways. You know, you might not show all of these things because they don't really apply to a particular client situation. So, you know, in this case, there are more on here. You know, do we care about Medicare premiums for this particular client? Probably not, right? I'm not going to show a client who's in their late 30s, early 40s, anything about Medicare because doesn't matter, right? That's 25 years from now. But, you know, some of these things, maybe I show them, maybe I don't, right? Does it matter that they can't make a Roth contribution? Maybe it does to you. Lifetime learning credit, these kids, Dr. Harness, remind me, nobody's college age yet, right? Or are
Not
they?
yet. No, no, they're saving for college, but they're not college age yet.
Okay, so if we're saving for college, but we're not paying anything out that might qualify for these credits, I might choose to hide these. Right? No sense in putting extra information on a report for a situation that doesn't apply to a particular client. So we know we can probably get rid of the lifetime learning credit, student loan interest deduction, unless they're paying off student loans.
They are paying off
Okay.
student loans, but clearly they're over.
So, you know, we might keep that, but, you know, at their income level, they're never going to be below that if this continues. So maybe you keep that, maybe you don't, but I'm probably going to get rid of the American Opportunity Credit, probably going to get rid of the adoption expenses credit because that's not going to apply to this particular situation. I'm definitely going to get rid of the savers credit because they're way over that and it's not worth spending the time to talk about it. These other two, you know, your mileage may vary, but now when I print out the report for a client, all I'm showing them are the things that might apply to them. Right. Again, I'd probably choose to hide the Medicare one. Not necessary. So, you know, again, do with that what you will. Itemized deduction. This can be helpful as we're talking about these folks because we know that they've got charitable intent. They're hitting the maximum that you can deduct for state and local taxes, mortgage and investment interest expense. This might be worth at least keeping in the back of my mind as their planner, because these two things by themselves are going to get them over the standard deduction every year, right? So I'm looking at that and thinking, like, do I need to talk about bunching charitable contributions in a particular year? Probably not, right? Because they go over the standard just by these two items alone. So we don't need to worry about making 5 years worth of charitable contributions in 1 year. One of the really nice things about Holistiplan, again, it's reading from the Schedule B. Schedule B is the one that talks about your dividends and your interest from all the different sources. This is a great opportunity to uncover an account you might not know about, right? So if you knew, hey, there's a TD Ameritrade account, of course I should see that. Oh wait, Merrill Lynch. I don't custody with Merrill Lynch. They've never told me about this. What's that about? That's an opportunity to have that conversation of, hey, I saw this on your tax return. Let's talk about that, to dig a little bit deeper. And then the Schedule D stuff talks about short-term losses, long-term losses. Oh, wow, okay, big $55,000 loss. That's important to know. We know that we can carry it forward into this year. Obviously, we can't go back and change anything related to last year, but this is now a neat planning opportunity, right? What is it not telling us? Well, it's not telling us the nature of all of this income on the ordinary side. You might have to do a little bit more digging into the tax return to do that. The tax report that Holistiplan baseline puts out with observations might pick up on that. But, in this particular case, we know that there's some salary, but there's also business income. And whenever you see self-employed or business income, that can start its own little flag of, oh, there are retirement plans that are unique to self-employed people, right? SEP IRAs, simple IRAs, something that solo 401ks, right? Something that might help improve cash flow, allow for retirement savings in this tax deferred vehicle. But it might also clue you to look at what that business income that's a Schedule C and say, like, okay, what else? What do I see on here? Not that I'm an accountant, right? I'm not going to do that person's books, but if I see Schedule C income and I only see income and no deductions, that might be a clue too to say, did they really not generate any expenses in coming up with this income? Maybe they bought stamps, right? Well, that's deductible, right? Maybe they bought office furniture.
Nobody buys stamps anymore, Ben. Come on.
I know, like I realize that, and I know that that's dating myself, but I just bought stamps a few days ago. So it's top of mind.
You buy some CDs as well?
Yes, I did. I bought some bearer bonds, and now I'm going to terminate this because you're making fun of me, and I will not stand for that. All right. So we haven't even touched anything else about future years, but there's a lot of information that you can glean just from this report and just digging into a few important schedules from the tax return itself. But where Holistiplan allows you to take stuff maybe to that next level is to say, yeah, this helps for 2020. Well, what about 2021? Well, if you click on this little link titled Scenario Analysis, what you're going to see are a bunch of columns and a bunch of rows, which are basically allowing you to say, if I just want to assume that 2021 is going to look exactly like 2020, if I come into this select an action for this column and click copy from scenario 1, what you're going to see is that scenario 2 now looks exactly like scenario 1 for every row: wages, taxable interest, qualified dividends, total dividends. And here we really are breaking stuff out, right? Taxable IRA distributions. So this particular client, every student knows there's an inherited IRA, but they're not taking an RMD because they don't need to. But if you wanted to model what taking taxable IRA distributions would look like in future years, you could, right? Roth conversions. So if you wanted to say, yeah, I think maybe a $10,000 Roth conversion would make sense. Well, you can actually see the impact of that on somebody's taxes by modeling a $10,000 Roth conversion. And then sometimes you do that and you say, like, the answer is not necessarily intuitive, right? You might think it's only based on adding an additional $10,000 for their marginal rate. But what if that $10,000 of income disqualifies them from certain credits or certain deductions, right? It's not always that simple. And trying to do that off the top of your head and memorizing there are 14 different modified adjusted income, modified adjusted gross income calculations that I need to be mindful of, you just can't do it, right? Let me delete that out. But this is how, if I were to do what is next year going to look like, this is how I would do it. Start with this baseline of, well, last year and this year might look the same. If it doesn't look the same, here's where I can edit things, particularly on, say, the wages side, right? So if I know that this year they're going to get a significant raise and their two wages together might be $400,000, well, I could go ahead and actually input that and see, you know, the impact on their taxes this year, assuming everything else looks the same. We've got our carry forward loss, so we know that we're going to have $55,000 of long-term capital gains. So in 2021, what I'm definitely going to do is delete that out, because otherwise I'm assuming they get another $55,000 loss, and that's probably not true. Unfortunately, we can't carry the losses forward yet in scenario analysis. It's something that we're definitely working on. So you just have to be mindful of, hey, there's a $52,000 loss that's being carried forward. But knowing that might allow me to say, okay, well, if I do a long-term capital gain sale of even $50,000, I can do that, and it's really not going to matter from a tax point of view, right? Because I've got this $52,000 sponge of a loss that's going to soak up a $50,000 long-term capital gain.
Hey, Ben, to trick the software, could you just reduce their income by 3,000?
You could, or you could just do that.
Ah, gotcha. Yep.
Right. So if I'm not taking any other losses, I'm just going to say I'm going to have a minus $3,000 amount there.
Gotcha.
I would do that because sometimes putting this in other places might have other cascading effects.
Yeah.
But the reality is, like, this is where it's going to show up.
Yep.
Right. So that's how I would do it. Here's my Schedule C income, right? So I know I've got business income. Am I taking a deduction for a SEP IRA? Have I made that recommendation to this particular client, right? I'm trying to remember on this worksheet side. So it shows you the Schedule C income. You know, was it qualified business income, right? I know that's a more complicated concept, but potentially, depending on the nature of the income and their other income, there's an additional deduction that you might be available for. So there's really a lot of things that you can get into. This is like second, third level stuff. So don't worry about if this isn't second nature to you yet, but these are the sorts of questions that I might be asking. What is that income? Is it possible that there's a qualified business income deduction that we didn't take last year and it's too late, but we want to be mindful of for this year, right? And what you've basically done then, assuming that nothing else has changed, you've said, okay, here's what 2021 is going to look like. You're going to have $351,000 of income. Your adjusted gross income is going to be a little bit higher. Your deductions, we've said those aren't going to change. If you wanted them to change, to say, hey, we want you to make a bigger charitable contribution, just making that up, right? Let's say that they donated $15,000 instead of $7,200. You'll see that it's going to work a little slow. Now, what do we have? Well, higher deductions, lower taxable income, credits aren't changing. And so what happens? Well, their taxes are a little bit lower. Marginal bracket hasn't changed, but their actual tax bill is a little bit lower. This is how the scenario analysis works. But one of the things that, again, truly sets Holistiplan apart is to say, you don't need to go in and make these iterative changes just to see the impact, right? What does that mean? Well, this range calc button, if you click that, this is probably my favorite feature and where I spend a lot of time when I'm working with my own clients. It's going to show me on a graphical way, both for ordinary income and long-term capital gains, assuming we can get it to load, how much more room I have in my current bracket before I see the jump up to the next one, right? So what is this telling me? Well, I've got $24,000 of ordinary income that I can play with before that next dollar gets taxed at a much higher rate. So you might have a client that says, I'm cool paying 24% on income because I think tax rates are going to go much higher. Well, okay, if you do a Roth conversion for that person, you could say you could convert potentially up to $24,000 of an existing IRA balance pay your 24% tax hit now and not have to worry about that next dollar. And then you see that big jump, right? Same thing is true on long-term capital gains. Remember, we've got a lot to play with here. Now, in this case, it said the baseline capital gains is this minus $3,000. Again, it's a little funky because we've got that big loss to work with, but hypothetically, you could say, okay, I don't really need to worry about capital gains for a long period of time before that next dollar kicks in. But you can also see a couple of really neat things going on. The different colors talk about the different taxes that are impacting you. So the blue is, okay, if you take a little bit more, maybe your taxes on ordinary income go up a little bit. We've got the net investment income tax, right? These are higher income folks. So they're looking at that 3.8% additional tax on either their net investment income or the amount they're over the threshold, whichever is less. And you see that stays consistently here. And then where do we see this big jump? Well, when your income gets too high, you actually go up from a 15% baseline marginal tax rate on long-term capital gains to 20% on long-term capital gains. I love this. Sometimes this is a really helpful way of showing clients how these things all work together because nobody knows this, right? This is not intuitive. But when you can actually show people this, it sometimes can drive home the point of, hey, this is a good idea. Look how much room there is. And if you're comfortable paying a 32% tax rate, look how much room you have to run here. That's just these particular clients. Sometimes you have other clients where the plateaus are much bigger and they might have otherwise been hesitant to do something, but you can show them, hey, you don't have to worry about, you may have to pay more in total taxes on a dollar basis, but on a rate basis, you've got a long runway before you have to worry about that next dollar being that much more expensive. So I love this. You can also get similar answers to some of these things by there's this solve for max button. So if you push that, it tells you how much more room you have and your next change in your effective rate for the next dollar. It's the quick and dirty way. There's no graphics, but it shows you, okay, if you really just want to know the answer, here's where you have to worry about the next thing happening. So kind of a quick run through, but a lot here, primarily focusing on the big takeaways from that 2020 tax report. And then how do I start modeling what 2021 might look like either as a baseline or let me actually do this. I'm going to rename this 2021 baseline. And then I'm going to do another one that's just going to copy from scenario 2. And let's just, I don't know why we do this, but let's do 2021 Roth conversion. Because I've copied 2021 as a baseline, it's carried forward everything that we've said was going to happen in 2021, except now we're just going to do a $15,000 Roth conversion. And why you might do this is because if that's the only variable that's changing, you can now very quickly scroll down to the taxes and say, okay, that $15,000 Roth conversion resulted in, just under $4,000 of additional tax. I love that, right? Because you can show this to a client. You can either do it live, you can print these out, right? So you can print the current view if you didn't want to do it live with them, because there's a lot of stuff going on in here. If you didn't want to show all these different things, you can minimize any of these carrots.
Did you traditionally show this live with a client or did you print?
It depended on what I wanted to show, right? And that's usually the answer for most really good questions is that it depends, right? At some point, your clients. And if I were to show this screen, I always preface it with, there's going to be a lot on here, right? So I'm leading the witness and just letting them know this is potentially going to be more than you need to worry about. I'm going to focus your attention on the most important things. But that's also why I particularly liked jumping to the, if I can get there. Oh no, I closed out of it, but I think we were done. If we could get to the range calc, not the, and just show them graphically, like I've told you we would do a $15,000 Roth conversion. This is where we got to, right?
That's good. That is really, to me, as I sit there and watched this unfold, the thing that jumped out to me the most was speed. to do this with every individual client or even a percentage of your clients by hand and run scenarios would take you, I mean, you could build some Excel spreadsheets to speed up. There's some things you could do, but man, you just can't do it fast enough
Oh,
at
no.
scale to work with a large number of clients.
No, not at all. There we go. I got back to the range calc. Yeah, you can't. It's impossible, right? And so if you're trying to do it on a spreadsheet basis, what you're doing is you're recreating it every time.
Mhm.
You're trying to make sure that you've got all those little ins and outs for where things phase out and where they don't, and where does Social Security start being taxable? Well, what income do you count for Social Security? Because it's different, right? When you're trying to figure out how much of Social Security is taxable and how much isn't, it's too much. It's just too much. So you can do some quick and dirty stuff and maybe get some directionality by doing something that's jerry-rigged from an Excel spreadsheet, but you're asking for mistakes and you're also asking for repetitive work and having to rebuild it every single time. There's very few pieces of software in financial planning that truly deliver on what software and computers should do, which is to make certain things more efficient. This is one of them, right? Financial planning software is great. It does not make the financial planning process any faster. It makes it more thorough, but it doesn't necessarily speed it up. But this does, right? This takes the human element of going through a tax return and turns it from a 45-minute project into, if you're just worried about the tax report, 10 seconds, right? And then the scenario analysis allows you to actually add that level of human analysis and thought to say, yeah, I think this is a good idea. Let's check if I was right. Yeah, I was. I'm amazing. Or, oh, wait, it didn't have the impact that I thought it would. I'm not going to say that in front of a client and then have to backtrack a little bit later.
This has been really good, Ben. I can't thank you enough one, just for Holistiplan at large, investing in our students. We're really grateful for that. But two,
Absolutely.
to invest some time on top of that and to share how, what can we do with Catherine and Cody? Catherine and Cody represent some good clients. These would be great clients to work with, but they also have a lot of malleability. They're in their 40s. They've got a lot of runway out in front of them for planning. The things that you do now, the suggestions that you make, the planning that you implement can have enormous impacts across the next 25 years as they begin to plan out their financial future. Most CPAs, really good CPAs, can help point to behavioral changes that need to take place to help offset or delay taxation. But a planner in coordination with a CPA isn't just looking at how much you owe to the government today. It's how do we reduce what you owe down the road? And I think this helps a lot in that conversation. So thanks for that.
Absolutely. Happy to do it. And congratulations to everybody at A&M who's taking these steps to get this far and doing the capstone. Like this is great stuff that you all are doing and learning, and Holistiplan is happy to help.